Alright, we're group one. We're introducing like creative accounting. I'll be talking about, I'll be introducing it. I'll be talking about what it is, creative accounting. And the structure that we have, as I said, I'll talk about what is creative accounting, but then Andreas will start talking about what the reasons are for using creative accounting, why regulators will want to prevent it, and then he'll pass on to Sophia, who will talk about the techniques of creative accounting. Then Janilin will talk about detection, how people detect creative accounting, and then Ashley and Sean will talk about techniques to try and prevent creative accounting. And then Edwin will conclude. So what is creative accounting? Well, a great man once said, it is using the flexibility in accounting within the conceptual and regulatory framework to manage the measurement and presentation of the financial reports to afford primacy to the interests of the preparers over other stakeholders. Google says it is the exploitation of loopholes in financial regulation in order to gain advantage or present figures in a misleading favorable light. And probably my favorite quote is that Patolis says it is the art of faking the balance sheet, whereas Le Double has a more positive view on it, saying it's the art of saving money. So what is creative accounting continued? Well, there is a point in which creative accounting becomes fraud, and that's when they start extending the numbers and using non-existent or prohibited practices, information and or transactions to find their way into the balance sheet. In other words, managing data outside of the conceptual and regulatory framework. Hind's story explains accounting as a way to recognize certain ideas, such as revenue, provisions, goodwill, and how those ideas are recognized and the value that they all recognize will differ from each individual. He also talks accounting as a form of constructing reality, as it is managing numbers. And one thing I like is that there's no having the full picture. So now we'll pass on to Andreas.
Alright, let's move on to the reasons of the use of creative accounting. According to Goldthorpe and Ahmad, there is two situations, which is macro manipulation and micro manipulation. Micro manipulation is when preparers become aware of a proposal to alter accounting regulation in a way that they feel will disadvantage to them. So they try to engage in lobbying to attempt to prevent the change. And a micro manipulation situation, preparers in altering accounting disclosures so as to create the view of reality that they wish to have communicated to users of financial statement. And similarly, according to Jeff 1978, the preparers assert the primacy of their own views of the world and seek to dominate the reporting process with the partisan version of the truth. And last but not least, Lyons 1984, he said that regulation that is poorly drafted can be easily flouted as enforcement mechanisms are inadequate. So basically, regulation loses authority. And next, I'm going to talk about why regulations try to prevent it. So basically, the first reason is the interest of the users of the statements sometimes are likely to be ignored. So it's a legal way of manipulating reporting process, but it's fraudulent. And next is ethically a problem. So they provide deceiving reports, but basically abuse of power, misuse of authority. So they are committing injustice. And the acceptability of accounting manipulation is often perceived as reprehensible. Next, I'm going to pass it to Sophia.
I'm going to be talking about the techniques of creative accounting. So first I'll discuss regulatory flexibility. Accounting regulation often permits a choice of policy, for example, in respect of asset valuation. Business entities may quite validly change their accounting policies, and as Schwipper in 1989 points out, such changes may be relatively easy to identify in the year of change, but are less likely and less readily discernible thereafter. Next, I'll discuss the lack of regulation. Some areas are simply not fully regulated. For example, there are as yet very few mandatory requirements in respect of accounting for stock options. Management has also considered a scope for estimation in discretionary areas. McNichols and Wilson in 1988, for example, examined the discretionary and non-discretionary elements of bad debts provision. Next, I'll discuss the reclassification and presentation of financial numbers, and which are relatively underexplored. However, the study by Graham Litch in 2001 suggests that firms may engage in balance sheet manipulation to reclassify liabilities in order to smooth reported liquidity and leverage ratios. And finally, the pooling of interest merger accounting produces combined statements that show the combination in much better light than under the alternative method of acquisition accounting. Pooling has been heavily used. One recent estimate in that of 1998 is around 55% of new business combinations out of a total of 11,400 transactions were accounted for under the pooling method, according to Ayers in 2000. I'm passing on to Jenny Lee.
There are some simple ways to detect creative accounting. For example, when a company relies heavily on external debt, it tends to manipulate its revenue to demonstrate that it has the ability to pay off the debt. So auditors should pay more attention if their client is highly leveraged. Also, late submission of financial statement can be a warning signal. Failure to submit a company report on time may happen for many reasons. The company may be in financial difficulty. There may be disagreement among management, or regulatory requirements may not have been complied with. So any one of these could be the factor that pushes management into adopting creative accounting practices. However, with these simple methods, it is still difficult to detect all creative accounting practices. So next, this is the checklist modified by Maud Sanusi and Matt Iser. And this checklist mainly focused on three areas: revenue checklist, asset checklist, and amortization policies checklist. So this modified checklist can be used by anyone, as all this information can be found through the financial statement published by the company. However, it is still not possible to detect all creative accounting just according to this checklist. Now I'm gonna pass on to Ashley.
So I'm going to talk about how regulators prevent creative accounting. Current accounting rules under the IAS and GAAP allow managers some choice in determining the methods of measurement and criteria for recognition of various reporting elements. The potential exercise of this choice to improve apparent performances increase the information risk for users. Financial reporting fraud, including non-disclosure and deliberate falsification of values, all add to the user's information risk. In order to reduce these risks and to enhance perceived integrity, financial reports must be audited in by an independent external auditor, who then issues a report to accompany the financial statements. This in turn makes it difficult for preparers to manipulate data, as any discrepancies in the two reports would hint at manipulation. In addition, the committee of the board, comprised of independent non-exclusive directors, can play an effective role in preventing the misuse of creative accounting techniques and observance of ethical standards of financial reporting. Jean, 2004, studied the impact of corporate governance on creative accounting for Chinese companies. His study showed a decrease in earnings management after the regulation of Code of Corporate Governance. With respect to ownership concentration, state ownership is more involved in dressing up the books than privately owned firms. I'm going to pass over to Sean.
I'll be talking about prevention and the limitation of creative accounting. First, I'll list out what's the limitation of creative accounting. And creative accounting involves flexibility in accounting within the regulatory framework, and thus it is difficult to be prevented. It is mainly down to the ethics of companies and accountants to prevent creative accounting for the benefit of financial reporting. Colas 1996 defines creative accounting as the practices of disseminating accounting information, which are often at the border of breaking the law, that are used by certain entities who take advantage of the loopholes of the law so that they can present a better financial situation, a better performance, a better everything for their personal gain. Companies often unintentionally promote creativity or error if every office manager is left to run the system as they deem fit. To avoid and prevent creative accounting, have a head accountant to train everyone and to check that everyone follows the new practices to the letter. And another way of preventing it, have more internal control and regulations within the company, such as hiring an internal auditor, where there are more checks and balances which questions profits, margins, and debt recognition. However, this could incur more costs on the company as this requires more financial funds to double check its accounting books, and this is also down to the ethics of internal auditors and its relationship it has with financial accountants within the company. I'll pass on to Edwin, who will do the conclusion.
Right. To conclude, creative accounting is not fraud. Creativity is could be seen as something positive, especially if employee creativity is seen as a way to improve organizations. Why shouldn't accountants have this power too? However, obviously, as mentioned earlier, by Rules 1972, once this power is abused, then it would bleed into a way of creative accounting becomes fraud, and that is obviously not good for the company's reputation. The use of creative accounting may stem by personal incentives. People want to make as much money as they want, more benefits, job security. If they want to meet expectations, then they want to keep their job. They want to lose. They want to show that the higher ups that their company is doing well, their firm is doing well within the industry. Some of the ways that obviously mentioned earlier of limiting this usage was to enforce the usage of independent external auditors, because they would have less bias to the company, so they would view the financial statement as in a more true and fair view. Reducing the number of permitted accounting methods, this would lead on to more of the IFRS or ISAB to enforce law into reducing the accounting methods, the alternatives that companies can choose to affect their records. And corporate governance. Shareholders could essentially hire managers to manage the managers who are sorting out the financial reports to make sure they are not crossing the line of creative accounting into fraud.